It's been a very strange and difficult year with the market being so detached from what the Fed is actually saying. Christopher Waller last Friday spoke about this, and he said, the lag effects that theorists, academics, and I suppose Fed policymakers have described as being in place, the lag after they hike for the full effect to take in the economy. He was saying that should be decreased now because in the modern Fed era, they give forward guidance. They give the dot plot. They do press conferences. These are all things they didn't used to do. And he described the Fed as being very secretive. And there was a whole industry around Fed watchers, the kind of stuff that I've been doing for the last several months, listening to what they say, trying to glean some insights, their interpretations of the data, and come to conclusions on what their next decisions might be. Now, this year's been very strange because despite the dot plots, despite all the Fed commentary, the consensus bid has been initially Fed pauses, Fed pivots, Fed stops, cuts by the end of the year, and that simply has not materialized. Yet, we have seen a stock market continue to rally, and most notably, because the initial rally, okay, maybe we were a little oversold, start of the new year, sure we can bounce. It peaked out just about after a month, Fed meeting, some weaker earnings, and pulled back. And it pulled back until SVB. And this is where things got weird and strange. The day before SVB failed is the equivalent to tomorrow. Tomorrow will be the second day of Powell's testimony. Powell testified before Congress. The next day, SVB failed. The market that weekend decided that there was no way in hell Powell was going to go tighten after SVB failed the day after his testimony to Congress. No way. And that was a somewhat reasonable assumption unless you really listened to the conference or to the testimony and heard what he was saying and interpreted, him going from one day saying the era of secularly lower rates that we've been in for the last several decades was likely over to pivoting. Unless you thought that was a big stretch, which we did think was a big stretch, but the market did not, then you weren't changing your opinion that week. But for the vast majority of people, the tightening was over, and they had broken something, and they were going to have to stop. And that was a relatively reasonable assumption. I'm not saying that was a stupid thought. I'm not that kind of guy. I understand where those people were coming from at the time. But the truth of the matter is that has simply not played out. And now we're hopefully getting a bit of a reality check. This is the one thing that has not been in place all year. The ability to actually listen to the Fed and, do what they continue to do in spite of what the market initially says they're going to do and actually be right. What a mind-boggling concept. The market's saying one thing, the Fed's saying the other. You stick with the Fed, and you end up being right. We've been right in the fundamentals, but we haven't been right in the stock market price action, and it's been very frustrating. It has not been a fun period of time. But hopefully that is over, because we are seeing notable moves in stocks. You can say Intel is something specific, but you look at the entire SMH, and that includes NVIDIA. That ETF, the semiconductor ETF, is near the COVID highs that were well above the pre-COVID levels. And those COVID highs came in a period when companies were ordering everything they possibly could. There were chip shortages. Prices were flying. Now, technology and chips are very exciting. They're very flashy because there are these complex technologies. But the truth of the matter is, the chips business is cyclical. Just like any other business you love to hate, and lots of people love to hate. Energy, materials, industrials. These kinds of boring, disgusting businesses that trade at low multiples and have high dividends, they're really no different than the chips companies. Yes, maybe the chips companies have a higher growth rate right now. We'll grant them that. I'm not saying that they should trade at the same multiple as an oil refiner or an oil producer or a coal company or a copper miner. I'm not saying that they should trade at the same multiple. What I am saying, though, is that at the end of the day, it comes back to the cash flow. It comes back to the return on equity. And maybe there's a little bit of a correction that needs to happen because we thought that the price of capital was going to go down. We thought rate cuts were going to happen sooner. Some people might try to, cling so strongly onto what Bostic said today, or one or two quotes from that. I just want to push back on focusing on one of the two doves who at this point in time wants to pause. One, he said not only no rate cuts this year, obviously, but no rate cuts for most of 2024. Most of 2024. Additionally, he says no rate cuts because he anticipates as inflation falls, holding at this level will actually continue tightening. He continues to want to bring demand down, to continue to want to slow down the economy. Why is that? Because as inflation falls, if you keep interest rates the same, the real rate grows. So he wants to keep pressure on the economy. However, Bostic also said that if the economy doesn't begin to slow down, that they would have to reevaluate the rate outlook. So this is by no means somebody who is clamoring like the Bulls were that the Fed has done enough. They need to stop. They need to start cutting soon. The job is done. That is not what even the people who actually want a permanent pause at this point in time, with this amount of data that Powell said today, they have continued, and forecasters, this is the truth, have continued to be surprised by. Even the people who want to pause still view additional economic slowing and technically additional tightening as necessary. So you have a market that fundamentally needs to correct to the Fed's outlook because it has postponed that for a very long time. It's currently not pricing that in anywhere on the rate curve. It's not pricing that in on FedWatch. So it needs to do that. It also needs to grapple with the idea of maybe we've gotten a little too excited by the lack of a recession so far. I get it. In hindsight, maybe I thought economic slowing was going to come at some point last year, as did many people. But in hindsight, that projection never made any sense. Why didn't it make any sense? Because you were never going to get a slowing down of the economy until Fed-induced slowdown in the economy until interest rates got into restrictive territory. Now, not only are you potentially going to get a slowdown in the economy, which I do think is going to happen. I think we're beginning to see that. We're definitely seeing it in earnings, even though, fine, it was slightly better last quarter. Still an earnings decline, despite positive GDP. And there's a number of reasons for that. Not only are we going to get a potential economic slowdown, but we're going to get, wait for it, disinflation. Inflation coming down. This is a big misconception because I feel like a lot of the bulls are just trying to run onto one data point and draw a big picture from a single data point, like a better than expected CPI or something. move on an announcement. The reason why earnings growth was so good the last several years since COVID is because companies could do something called take price. You go to earnings calls, they were talking about taking price. That's how they got the earnings growth. Now, as you constrict demand, you tighten credit supply, and your input costs have gone up, your demand is lower. That's the Fed's goal, to lower demand. This is going to affect everything in the economy. No question. If it doesn't, they're not done. You're going to lower demand. That's going to impact prices. Companies are going to have to start offering discounts. They're going to have lower volumes. It's not going to be good. It's going to require a re-rating of the multiple, which I heard today has only been higher during the COVID bubble and during the dot-com bubble. Think about that. And you're potentially also not only going to have to re-rate the multiple, but you're going to have earnings continue to decline. So that is another force, another downside force, in addition to re-rating the multiple, based on a change in growth rate. And that's before you get a change in interest rates. So when I break everything down, when I look at all the data that I can see, and I try to interpret it, and I come to these conclusions, it's very hard for me to be bullish, and it's very easy for me to continue to be bearish. And it's been a very difficult year because the market has essentially, since SVB, disconnected itself from the Fed, and 7 stocks have moved the indices in a very dramatic way. Those 7 stocks, I believe, are up something like 90% year to date, some crazy double-digit number, over 50. Today, they're giving some back. That's a first positive, good sign. But I still think there's more to come. We saw, despite everything Powell said today, yields come down. The market continued to interpret it as a, whoa, scary moment. I think the yields coming down is a short-term flight to safety type of event, because he said, essentially, he was asked, if there's a recession, are you going to change your view? Are you going to change interest rates because interest rates can cause a recession? His response was, we have to focus on price stability. Essentially, they're not going to cut rates if there's a recession. They're very much open to that possibility. So that can explain the interest rate decline today, but I still think it has to reverse. Fed watch, less than 10% chance of 2 rate hikes by the end of this year. But it's not as if a cut is expected in January anymore. Bostic, the biggest dove of late, based on what he said today, the only one who's actually talked about wanting to pause, even Goolsbee didn't do that. He says no rate cuts for most of 2024. So this is a hawkish Fed. The market needs to come to grips with it. It has not done so yet. And we can't rule out the possibility of an economic slowdown. We just can't do that. I get it, it hasn't happened yet. Of course it hasn't happened yet. Interest rates just got into restricted territory. Let's see what happens. We need time. Time has to play out. Things have to happen. We're not trying to play overnight here. We're trying to stay calm and carry on with our views and our great businesses that we can be long at good prices. We talked about the S&P 500 multiple and where it is. Highly debatable if prices are good overall, but I'm sure you can find some good spots, and I still like energy. We've talked about that before. If you want to hear about it in tomorrow's video, please leave a comment. Don't forget to like and subscribe, and that's today's video. So until next time, peace out.